Hello and welcome to Business Today Television. I'm Siddharth Zarabi and you're watching Easynomics. The consumer price inflation data for September is set to be released in just a few minutes from now. Estimates suggest retail inflation likely fell to a 3-month low of 5.4% in the month, returning to within the RBI's tolerance band of inflation after 2 months. And this is going to be significant if it were to come true. And to decode those numbers, which are expected in just a few minutes, and the dynamics around inflation, I am joined by economists Rajni Sinha, the chief economist at CARE Ratings. Thank you very much for joining us. Rajni, the backdrop to the inflation data release is very clear. We would be wanting to see inflation fall. If it were to happen, what's your own sense? Why would it have lowered at the current level?
So, Siddharth, the spike in inflation that we saw in the last 2 months was mainly because of sharp increase in food inflation and specifically vegetable price inflation. And vegetable prices have now started moderating. And that's the reason inflation moderated in the last month. And this month, we are expecting it to fall below 6%. Our estimate is a little higher at 5.7% compared to the consensus estimate. But yes, we are also expecting it to moderate. That's mainly based on the assumption that vegetable prices will moderate. Otherwise, if we look at other components of inflation like core inflation, that has been moderating and we expect that to remain moderate.
Okay, core inflation has been moderating, and clearly there are also risks for the future. And before I continue the discussion, let's quickly listen into what Petroleum Minister Hardeep Singh Puri had to say on that very crucial issue of crude oil prices, especially with the latest conflict that we are seeing in West Asia.
To reason that if the crude oil prices go up, and this is something I said at ADIPEC also, which was much before the present phase of turbulence, then that has a very strong impact on an adverse impact on the effects, on the attempts at global economic recovery. That's one. Secondly, I think in the 5 days that the operations, Hamas, Israel, and these military operations, which look like getting escalated, I think the global markets will factor all things into account. And if the supply lines are not disrupted, hopefully we will be able to navigate through everything happen. But this is not something on which I would like to speculate. And I don't think you or your news agencies would like to speculate either. What we are doing is we are watching this on a real-time basis. And I'm confident that we means as in India, we will navigate this both on availability and other factors.
And the latest estimate that's come in on oil supplies, the IEA has said that it sees global oil supply rising 1.7 million barrels per day to a new high in 2024. So that's the supply side, and you heard the petroleum minister talk about the possibilities and uncertainties that exist. Rajni, you were talking about vegetable prices. Let's try and take a look at the trajectory of inflation since the beginning of the current financial year. 4.7%, then a dip of around 40 basis points, then a increase back, and you have those numbers on the screen. July 7.44% and August 6.83%. You were making that point about August. I want to ask you, therefore, is it clear that this trajectory downwards is a firm one, Rajni?
So overall, if we are talking about CPI inflation, yes, we expect it to moderate further in the coming months, at least the next 2 months. But broadly, we expect CPI inflation to remain in the range of 5 to 5.5% in the current fiscal year for the remaining months. And for the full fiscal year, our average estimate is 5.6%, a little higher than what RBI is saying. But yes, it is expected to moderate, but at the same time, the point to note is that it will still remain above RBI's target of 4%, which implies that RBI will remain cautious. And like you highlighted, there are some concerns which can put upward pressure on our inflation projection. One is the crude oil aspect, which you highlighted. Though in our projection, we have assumed that retail prices of petrol and diesel will not be increased in the current fiscal year, and that's why we have this number around 5 to 5.5%. And the other concern is the skewed distribution of monsoon and the impact that it has had on Kharif sowing. Like some of the crops, say pulses, the sowing has been impacted. And
Right.
while overall food inflation is going down, cereal inflation still remains high.
All
And
right, we have the India September CPI combined inflation rate coming in at 5.02% versus 6.83% in August. That's a steep decline over even the consensus estimate of 5.4%. Let me get that number back up on the screen as quickly as we can. India September CPI at 5.02%, food price inflation at 6.56%, rural inflation at 5.33%. We are seeing a significant decline when we look at the components of inflation. Urban inflation at 4.65% versus 6.59%. So a sharp decline, more than even consensus estimate. So extremely good numbers as far as the September consumer price inflation data coming in. The combined index is down 1.1% on the month. I'm going to go through those numbers once again, playing out on your screen, viewers. September CPI 5.02%, and this is lower than even the consensus estimate of 5.4%. I'm trying to look through some of the entities that had called it, and I can't see such a number. The lowest number between ICICI Bank and Deutsche Bank at 5.19 and 5.2 respectively. That's the lowest, and this is a very, very significant decline. Cereals and products index up 1.2%, so that's a bit of a bother. This is the latest number, and Siddharth Sanyal, Chief Economist at Bandhan Bank, also with us. Siddharth, quick reaction to those numbers that you just heard.
Yeah, very interesting, this particular drop. Just one particular point I would like to highlight. Last week, the RBI, when the RBI had their monetary policy, they had given their projection for the July to September quarter average inflation. And they had mentioned a number of 6.4 as an average inflation. And if you do the maths, because we knew the July number and we knew the August number, the September number was indeed coming at around 5% or maybe a tad lower even. So
Okay.
that time RBI had kind of given an indication from their numbers. So to some extent, market started taking that into account as well.
So
Having
in
said
line
that,
with the RBI number, I just want to take some more numbers for our viewers. We now have industrial growth numbers also at 10.3% versus 0.7% on an annual basis. So a significant number when it comes to industrial growth, above the Informist poll that was at 9%. And let me now go back to inflation as we get some more details. The vegetable index is down 15.8% on month. Pulses and products are up 4.1%. Oils and fats index down 0.4%. Food beverage index down 1.8%. Clothing footwear index up 0.3%. The housing index is down very marginally at 0.1%. That's some of the detailed data when it comes to inflation. Just want to take the industrial growth number once again for our viewers, and let's try and bring that up on the screen as well. Industrial growth at 10.3% versus 0.7%. The fuel and light index is also down 3.9%. Rajni, coming to you very quickly on those numbers. Cereals, pulses, a bit of a bother seeing a increase, but everything else much better than expectation.
So yes, that's the trend we have been seeing. So this sharp fall would have happened because of a sharp fall in vegetable prices. But like I was saying earlier, the bit of a concern is that cereal price inflation and pulses inflation remains high. And given that the monsoon has been skewed in many regions and specifically for pulses because the sowing has been impacted, we need to be cautious on that front. But apart from that, as I mentioned, and probably even this data would have shown, core inflation, that's another comforting factor that has gone below 5%. So, all in all, I would say that inflation has been moderating, is going to moderate going forward also as per the projection. But we need to be watchful on some parts of food inflation, specifically cereal and pulses.
Siddharth, continue with your analysis of the numbers that you were talking about.
Yes, I think this particular outcome is a very positive one, no doubt about that. But having said that, I'll actually remain cautious. I mean, given the outbreak of the geopolitical tension, I'll be a little cautious on a few factors. The oil price angle is obvious and direct. On top of that, there's one particular factor which was helping us over the course of the last few quarters, which was the easing of the supply chain bottlenecks in general in the global on the global trade front. Now, this particular conflict, being at a very important strategic location so far as India's trade with Europe and a lot of African countries are concerned, this might actually open one more angle which needs to be dealt with, which needs to be seen how exactly that play out so far as global supply chain bottlenecks are concerned. That is one. That is very immediate, and we'll possibly get a bit of a hint over the course of the next few weeks itself. The other angle, which Rajni obviously mentioned about the weather-related uncertainties, specifically in case of India, also globally. Along with that, what is coming occasionally these days is a little bit of escalation of restrictive trade practices globally. That is again making a bit of a comeback. So that's why, even on a very near-term basis, while we are positive in terms of the trend of further softer inflation trajectories in general, I'll be very watchful about these few factors, especially given the outbreak of the geopolitical situation.
Rajni, as I come to you, I want to add the industrial growth data that we are also getting. So we have mining sector growth at 12.3% versus a negative 3.9%. Viewers, this is August data. Inflation is September because that takes a month more to come out. Manufacturing 9.3% versus a negative 0.5. Electricity growth at 15.3% versus 1.4. Primary goods output 12.4 versus 1.7. Capital goods output growth at 12.6% versus 4.3%. Intermediate goods up 6.5% versus 1.3. Infra up 14.9 versus 3%. Consumer durables output 5.7 versus a negative 4.4. Consumer non-durables 9 versus a negative 9. I'm going to repeat that. Up 9% versus a negative 9%. Industrial growth for July has been revised upwards to 6% versus 5.7%. So the headline at this stage really, Rajni, inflation cools, industrial growth is up, good macro winds for the Indian economy, the industry is firing and inflation is cooling. Couldn't have a better set of numbers to discuss, Rajni.
Definitely. And actually, I would like to highlight the positive thing is you spoke about item breakup of the number, and construction and infrastructure, that segment had been recording very good growth in the last few months. What is the positive thing is from the data, what we saw is that consumer durables and non-durable segment have also recorded good growth. So that's something which we would be watching very closely, because that is something which is very significant given that India is a consumption-led economy. So if this trend is continued, because specifically what we were seeing is that consumer durable segment was not seeing good growth, Consumer non-durables, we were worried about rural demand recovery. And now with the monsoon not being good, we were concerned that the rural recovery may not be good. But now if IIP consumption goods, both durables and non-durables is good and it is maintained at this kind of momentum is maintained in the coming months, that would definitely be very good for the economy.
Okay, very good news for the economy. One more point, viewers, as I go to Siddharth. IIP growth, Siddharth, is at a 14-month high. And while you comment about those numbers, I just want to ask you, from a consumer point of view, no need of a rate cut anytime soon now.
Oh, well, I mean, given the uncertainties globally, of course, and no central bank will venture into that territory. But yes, I think the demand for that will also not arise. So most probably on the red side, we are some kind of the best possible scenario is to move sideways for a while.
Yeah, well, you know, that is what economists discuss. But when we talk to the average consumer, they say, hey, you guys talk about these big numbers and much of it doesn't make sense to us. Tell me, is my EMI going to be lesser? Because over the recent past, we have seen the build-up in interest rates. Rajni, that same question, I'm digressing from and decoding these specific numbers. What does this mean as far as monetary policy is concerned over the next 2 to 3 quarters?
So even if this IIP number had not been so good, still I would have maintained the view that RBI is going to maintain status quo, because if you see the last policy meeting, while they did not change the policy rate, the governor was cautious on inflation front. And we just discussed what are the reasons why we need to be cautious on inflation front, even though the data is
But the
moderating.
governor would no longer now need to be cautious on the growth front. The point I'm trying to say is that our growth worries now not so pronounced.
So I would say, last few months, I would say growth worries were not so pronounced for India. And that's the reason why RBI could go ahead with this. There was not too much with 6.5% GDP growth projection, which RBI has. And most of the people have their projection, agencies and banks, brokerage houses have their projection in the range of 6 to 6.5%, which implies that there's not grave concerns on the growth front. So, in that sense, yes, I completely agree with you that RBI does not have the pressure from the growth perspective to cut interest rate. Hence, they will remain cautious on the inflation front, be watchful, and hence this fiscal year, definitely we do not expect a rate cut. If I talk about next fiscal year, at least in the first quarter, with inflation likely to remain around 5%, we do not see RBI cutting interest rate. Maybe from second quarter of next fiscal year, RBI could consider a rate cut.
Okay, Siddharth, that same question again to you, because if we focus on inflation, there is still some concern around cereals, for example, and a minor increase in clothing footwear index. So, from a RBI point of view, status quo at least for 6 months, if not more.
More than 6 months in our view. We do think you can actually can potentially think of a rate action. So the best possible scenario at this juncture is the global central bank, the US Fed, etc., do not hike anymore. They keep moving sideways. We move past the inflation hillock, and also the political event around in the summer. We see the next full year budget sometime around June, July, and then possibly August onwards, there is the window really opens up if you think about only smooth macroeconomic data. Having said that,
Siddharth, since you spoke about the US, I'm interrupting you because on a sideways basis, what is the US Fed likely going to do? You've seen what's happening to bond yields, and the impact that it will have on a whole range of borrowers is going to be very significant, very pronounced. Is that going to possibly now worry the Fed more?
Oh well, that's a very important question. If you have noticed, within the last 7 days, the U.S. yields have touched close to 5%, and again occasionally have come down by some 30 odd basis points. And the very important thing is, if you have listened some of the Fed governors comments over the course of the last 3-4 days, their comments have been very dovish compared to past. So that actually raises the hope that Fed actually starts moving sideways from here on, rather than going aggressively for further hikes. And I think that may not necessarily be a bad policy at their end. But even if they move sideways, one particular thing the market needs to be absolutely prepared to be, that is to live with this current high rates for a sufficiently long period of time. Because even when the Fed is not hiking, and the market is assigning just about 30-35% probability to that particular event of another Fed hike in this particular calendar year. But the important thing is, Fed is clearly guiding that they are not going to cut in a hurry also if things are left to themselves.
Well, for the markets, Rajni, this is going to be pretty good news. Our markets have been resilient. They kind of bounced back really well after this shock Hamas attack on Israel, and we'll see that play out. But had these numbers been released within market open time, I think we would have seen a very sharp uptick, because some of the worries that the markets may have on the macro front will completely go away with these kinds of numbers, Rajni.
So, like Siddharth had earlier highlighted, some part of the market was expecting that the inflation would be lower this month because of the projection given by RBI, because of which people had done that back calculation as to what the number would be for September. But yes, it has turned out better than what was market expectation. So there could be some reaction on that. But broadly, I would say the market would also, what the market, India's bond market is concerned about is the cautiousness which was shown by the central bank in the last meeting. And the fact that they said that there is a probability of OMO. The point that they want to keep the liquidity in the system tight, which has caused the yields to go up. So those concerns will remain in the market. And RBI was very clear that while they have not hiked the rate, while they have not changed the rates, they have used, in some ways, liquidity to keep the rates high. So that's something which, market would be concerned about. But yes, the IIP data is better than expected, so there would be reaction on that.
I also want you to comment about what's happening in the US, because somebody who was on the show earlier this week called for and said that we may have seen a sort of US bond yields now stabilize, and we have seen some bit of that in terms of the increase not happening so fast. What's your own sense about the Fed strategy from here on?
So even if the Fed does not change rates, the point is market will be closely looking at what kind of statements are they making, what kind of indications are they making. And that, if you see, the Fed has been indicating that they would remain cautious. They are sometimes giving hints that there could be one more rate hike. So those are the things which will keep, market a little uncertain. And moreover, the Fed has indicated that rates are going to remain high for long. So even if, the rates are not hiked further, market is not expecting a rate cut to happen soon. And even if you look at the data that is coming from the US economy, we have been seeing pretty good data from US economy, which kind of also reduces the chances of further rate cuts. And on top of all these things, globally, the central banks would be concerned about what's happening on the crude oil price front. So I would say the central banks would remain cautious and higher for longer, which they have been saying will be the mantra going forward.
Since you brought up what the RBI had said, I just want to read out for our viewers the statement on that specific point by Governor Shaktikanta Das. He had said, and I quote, "A significant easing of inflation pressures from its exceptionally high level in July and August is expected to materialize in September, as the impact of fleeting food price shocks wane. Another element, viewers, that seems to have been at play and was of course factored in by most economists, and that is the reduction in price of household gas by 200 rupees per cylinder, and the estimate is that it may have helped lower retail inflation by nearly 20 basis points in September. Siddharth, as we try and look ahead this month, the next month, festive season, and then heading into the new year, what's your own sense about how inflation is likely to be?
Well, we think numbers move somewhat sideways. Numbers can move a little lower also, but not significantly lower than this particular point.
When you say little lower, are you hinting at a sub 5?
Sub 5 is possible. Sub 5 is very much possible, but not significantly sub 5. But I think more than whether it's significantly lower than 5 or just about 5, I think one particular point today we must acknowledge that if I go back by about a couple of months, there was the RBI Monetary Policy Committee, which was dealing with a situation where inflation was around with a 7% plus kind of a reading. The next print was also looking around 7% zone. Nevertheless, it's important here standing today with the benefit of the data in hand. We must compliment the RBI and the Monetary Policy Committee at this juncture that they didn't trigger any knee-jerk reaction, which could have been a very easy option for them had they been blindly thinking about inflation. So RBI, which had actually been very measured, nuanced, but at the same time very decisive and front-loading in their action in 2022 and the early part of 2023 in terms of their action, I think they did a commendable job couple of months back in terms of sticking to a thoughtful inaction also. I think that is also very important. That avoids a lot of knee-jerk reaction on the part of monetary policy, and hopefully we continue to see that going ahead in the coming months for India as well as for other countries.
Absolutely, that's a very good point that you make. And Rajni, as we wind down the show, the point that Siddharth makes clearly, the MPC and the RBI saw through this pretty well. They weren't caught by surprise with the spiral that we saw recently in July.
Yes, so the July-August spike was mainly because of food inflation, and that too vegetable price inflation, which is very seasonal. So I completely agree that it was a good thing that RBI kind of looked through this high inflation data and waited to see the numbers going forward. Because at the same time, when the vegetable prices were spiking, we were seeing core inflation moderating. We were seeing WPI inflation contracting. So those were the things. And anyways, when it comes to food inflation, it's a completely supply side bottleneck. And there's very little that RBI can do anything about it. And that's the time actually government took the required actions in terms of, controlling the supply of these food items in the economy through export duty or banning the export of some of these items, which is what was required at that time. Because RBI's actions for high food inflation would not have helped at that point.
Absolutely, and that's a important point to conclude this discussion and the coverage on the latest IIP and CPI numbers. India's inflation strategy, viewers, is working, and as our guests on the show have mentioned very clearly, the Monetary Policy Committee's stance stands vindicated with the latest numbers. Consumer price inflation at a 3-month low, beyond expectations, just about 5%, and Siddharth Sanyal on the show mentioned that it would likely dip below 5%, and Rajni pointing out that this is something that was expected, and the RBI needs to be complimented for how it has managed the situation. And even as inflation is down at a 3-month low, industrial production is at a 14-month high, and that is good news for the Indian economy, but some of the clouds and the uncertainties from the external side continue to hang somewhere there. Hopefully, they will not hit us in any negative manner. Siddharth Sanyal, Rajni Sinha, thank you very much for your time with us today. With that, it's a wrap on this episode of Easynomics. We'll be back with more. Until then, goodbye.